Hi everyone, welcome to another session of the Google UOB SME Leadership Academy. My name is Felix and I lead the portfolio management function of UOB Business Banking. We hope you and your families are keeping safe and healthy. I'm sure many of you, more than ever during these times, will need to balance work commitments with personal responsibilities. So thank you for taking the time to join us today. Before we jump into the content, we recognize that some of you may be new to live stream, so we'd like to share a couple of tips to make this as good an experience as possible. Firstly, we recommend that you join live stream via laptop or desktop for the optimum viewing experience. Secondly, we appreciate that you may have questions, so we have allotted 15 minutes Q&A. At the end of the session, please feel free to ask your questions throughout. You can do so via the comments section below, and please leave some time for your comments to appear after posting. Finally, we'd love to hear from you. Toward the end of the session, you will see a feedback survey appear. Please share your thoughts. They will be valuable inputs for us to improve the ongoing and future sessions. On that note, let's get started. The COVID-19 pandemic has triggered widespread slowdown to key economies in the world. After the unprecedented second quarter decline, what can we expect for the fourth quarter? When can we get back to the pre-pandemic levels? And what is the base case on outlook for vaccine development? And the United States will choose its 48th president, the House of Representatives, and 1/3 of its Senate next week. What's at stake? Today, we have our Global Economics and Markets Research team to share our views on these questions. We'll first have Alvin Liu, Senior Vice President and Senior Economist, to cover the macroeconomic trends and developments. We will then have Kun Hao, Executive Director, Head of Markets Research, to comment on the election outlook and the implications for interest rates and currencies. So with that, I'd like to hand over to Alvin. Over to you, Alvin.
Give me a second, let's switch to. Okay, hi, morning. Okay, thank you for having us again. And for my section today, I will talk a bit more on the macro outlook. And of course, there's no escaping the fact that in a few days' time, we'll be going to the US election cycle. And this is something that is on quite everybody's minds right now. And it's going to be a key factor, at least for the next few days, right, or weeks, right, that could actually have a significant impact on how the market's outlook might actually pan out. But for the macro outlook, let me just start by talking about what lies ahead. Definitely after the unprecedented second quarter decline, we have seen a significant rebound. We are expecting a significant rebound in the second half of this year, third quarter specifically. And already, if you look at one of the few major economies that had released the numbers, China, while it was slightly below market expectations, it came in at about 4.9% year on year. The numbers that are going to come out this week, especially in the later half of this week, today and tomorrow, we get a few of the major economies. Specifically, tonight we get the US third quarter GDP, and they are expecting a significant increase. This is coming off from, I would say, a historical, unprecedented contraction seen in second quarter. And that was largely due to, as we ourselves here in this region and in Singapore especially have experienced in the second quarter of 2020 itself, we had our version of a lockdown where we had the circuit breaker, and that was, I would say, that had significant economic implications. It was the struggle between saving lives and saving livelihoods that has been the theme of the contrast the comparison of what the policymakers should be doing. But the next point that we also want to highlight, of course, is the K-shaped recovery, the differentiation between different economies. Specifically, we see it within emerging markets and developed markets. And even within emerging markets itself, we see differences in the recovery process. And within industries, we also see that. And the reason is definitely some of the industries are more impacted by COVID-19, while some had actually benefited and thrived under the current pandemic situation. Then I mentioned before the US presidential elections, whether this will be a key risk event in fourth quarter. And my colleague Kun Hao will definitely talk more about that. But going forward, the recovery process remains highly uncertain, as you have seen in the news right now. We highlighted on the risk of any resurgent wave of COVID-19. And right now, we do see that in many of the developed economies, which has earlier shown a strong recovery in the third quarter. But now that recovery itself, the process, the trajectory, right, is now pretty much at risk. I think on the news overnight, Germany and France could be going into some form of lockdown again soon, or already announced some form of lockdown. And that itself, right, will actually put the path of the outlook, right, into a bit of a big question mark still going forward. In terms of the vaccine hopes itself, that would definitely be one of the game changers for this COVID-19 pandemic. But we also like to caution against being overly optimistic. Our base case remains that a feasible vaccine and somewhat of a good distribution or somewhat coming in on the mid of 2021. The optimistic case of a late 2020, early 2021 case, I think still to us is a bit of a cautionary tale. So we do have to keep an eye on that. But beyond that itself, we also like to look a bit on the US-China trade relations. We tie that with the US presidential elections, and that is that no matter, in our view, no matter who is the president, be it Biden or another re-elected Trump, the relations between the two countries will remain on a structural decline. It will still get worse from here. What would probably change is perhaps if we get a Biden presidency, a more cordial way of negotiation. But I don't think that we will see an improvement on that front. Here in this chart itself, on the chart on the right hand lower side, we have the growth outlook for some of the economies that are highlighted here. You can see that 2020, most of the economies are expected to see contractions, with the exception of some in Asia, specifically China and Taiwan. And in Southeast Asia itself, we expect Vietnam to still register positive growth, but this is quite well off its normal trajectory. If you look at 2018, 2019, Vietnam, for example, was growing at around clip of 7% and above. But this time, 2020 itself, we expect the growth to be under 3%. Going forward, based on a viable vaccine, and then definitely after the US presidential elections have been ironed out, we expect growth to return back to positive in 2021. But again, we will highlight the economic recovery path remains fairly uncertain, especially right now we are seeing that resurgent wave of COVID-19 in the developed markets. And of course, in several of our Asian regions, the COVID-19 situation remains still quite in a situation where you have to be closely monitoring. This is looking at the recovery process on the quarterly basis. And one of the things that does come off quite evidently is that there's an uneven recovery among economies itself. Some of these economies that we boxed up here are seeing significant trajectory upward, but then there are quite a lot of them are still looking at fairly negative numbers. And of course, if we move on to this latest IMF numbers, the projections for 2020 from IMF has been actually improved. The contractions have been reduced. But on the flip side, on 2021 recovery process, that recovery process has also been dampened slightly to reflect on the I would say the cautionary outlook based on the uneven recovery as well as the resurgence of COVID-19 in several regions. But some of the key important points that we do take off from the IMF projections is that through to 2025, they expect monetary policy to remain at current settings, meaning that they expect monetary policy to remain at the fairly very low and very accommodative positions for a prolonged period of time. They do expect social distancing, which will continue into 2021. But the assumption is that this will gradually fade in time as the vaccine coverage expands, not just in the developed markets, but also across the emerging market region. And I think some of the things here that they have assigned some assumptions. Of course, well, the biggest one in Europe is that they assume that a trade deal between UK and EU can be reached. But of course, if you follow the news itself, this has remained a bit of a difficult negotiation, even though it is still ongoing. And of course, the US forecast itself assumes no serious disruption from the presidential election. This is on slide 6 here itself, we show the uneven K-shaped recovery that I've talked about earlier, and some of the economies that are already on the recovery path highlighted here on the top end of the chart. US, China, Taiwan, to some extent, South Korea, and of course, Vietnam. Then the industries that were thriving under COVID-19, e-commerce, definitely technology, gaming, electronics, as well as definitely pharmaceuticals. On the other side of it, where industries are still being impacted and economies are still facing the challenges, some of the economies that are highlighted here, India, Indonesia, Thailand, and Japan and UK itself. While some of them, like for example, Thailand, you may highlight that they have a very low transmission domestically, and they have contained COVID-19 very well. But one of the things that hit them the hardest is the industries that are impacted by COVID-19 is tourism related, airlines and travel industries. And they have a significant portion for Thailand itself, revenues coming from that exposure. And with that itself, that also translates to the weak economic recovery process for them. Here we see that manufacturing in some of the economies have already returned back to 50, above 50, which means expansionary. But some of the highlighted box up items here show that some of the economies here are still struggling with the recovery process. In particular, I think Japan has been not a beneficiary of the recovery process seen in the third quarter, whereby their manufacturing remains under significant challenges, despite the fact that some of its peers in Europe and US and even UK, right, has seen manufacturing recovery back to expansionary territory. And of course, China has been one of the leading on the recovery end, especially on the manufacturing front. In terms of back to a bit on Singapore itself, I think one of the things that we like to highlight that we still see growth. Of course, in third quarter, we still see growth contracting, but the contraction itself versus the previous quarter, whereby the growth was more than 10% in the negative, things have improved due to the fact that, of course, third quarter we came out from the circuit breaker, but we have not entirely removed a lot of the restrictions yet. But monthly economic data for Singapore has been encouraging. If you look at the recent NODX and industrial production numbers, they have been stronger than expected. And I think that also is a testament to the government's diversification, the direction that the government has been going towards in well before COVID-19, whereby we have moved into higher value manufacturing activity, and a lot of this activity, including in areas of pharmaceuticals, have been very well sought after in this, especially in this current environment. And of course, on the technological front, those related exports and in production has also been recovering well. But we will put that there will still be many industries that are under significant challenges, especially for a very open trade-based economy like Singapore. And this brings us to the next one, which is travel and tourism. I think there's no easy way to describe this. They are the hardest hit and will probably be still the industries that will be significantly impacted until a lot of the restrictions between cross-border traveling is to be lifted. And if you look at the charts on the right-hand side, the two charts whereby we look at tourism revenue in terms of some of the key Asian countries, and you can see the pattern forming up there, whereby some of the economies that are more impacted are those that are more open towards or more dependent on tourism revenue. Thailand being one, and of course Vietnam is one as well. But Vietnam's economy, of course, is also a bit more different compared to, say, some of the other economies, in that it has also benefited from a lot of the diversification in terms of the trade flows and investment flows on the backdrop of the US-China worsening trade relations and basically tensions between the two countries. And Vietnam has been one of the beneficiary. And that's why, even though they are impacted on the tourism front, they have mitigating other sources of income coming in. One of them definitely will be on the investment side into the manufacturing sectors. And whether we can get back to pre-pandemic levels anytime soon, I think, as I wrote down here, probably not so soon. Why? You might think that we are seeing some of the quite impressive recovery numbers for at least some of the economies. We would think that some economies will be back on track. But if you look at this simple chart talking about, this is on global economy itself, the correction in terms of 2020's global GDP, right, based on the impact of COVID-19, right, is quite significant. Where you see the red dotted line that I highlighted here on the left chart, and that even after we see a recovery in 2021, expected 2021 recovery itself, we were still off that light blue dotted line whereby that was the normal trajectory. And I think at some point we need to continue to see the growth itself to get back to that blue line of the blue dotted line of normal, the trend back to trend growth, normal growth. And will we get back there in 2022? And we look at some of the IMF given forecast itself. I think trend growth wise, it is expected to be 2.55, about 2.6%. But in order to get back to that blue line trajectory, normal growth, right? Growth in 2022 itself needs to be close to 7.6%. Now, this is a very tall order, for a lot of economies to grow at that kind of speed. Maybe we can get that kind of growth for some of the Asian economies or the emerging market economies. One of them, of course, maybe we can get it from like Vietnam. And in terms of China's growth, we are also quite fairly bullish on the growth recovery process. We expect them to go above 8% growth in 2022. But then when we look at the other major economies like US, Europe, parts of Europe and Japan, it is quite hard to envisage that they will be able to, after a strong bounce in 2021, continue on with that bounce in 2022 itself. So if we were to judge, right, it will be still quite a way off based on this COVID-19 impact, right, for the global economy to return back to normal growth itself. Then in terms of monetary policy, on that backdrop, right, that also sets the stage that we will expect monetary policy, right, to be in a stage where we will be on a prolonged low rates environment for a significantly long period of time. I think the Fed has already announced a new strategy of average inflation targeting, whereby I think they will now seen to be willing to allow inflation to run higher than normal. How much higher? I think it's still a bit of a debate, but unlikely that the feel is that COVID-19 is generally seen as a deflationary event, and it may take some time for a lot of the inflation to come back, and that itself, right, will probably, even with Fed allowing inflation to be running hotter than normal, does not necessarily mean that inflation will get back above 2% anytime soon. And in terms of the rates, policy rates environment in, say, in the Asia side, I think we are not at risk of seeing negative policy rates, especially for China. We don't think for Canada as well, and most of Asia ex Japan. But in my final point here, that we do need to be cautious that that some economies may be at risk of going towards negative policy rates. UK and New Zealand seems to be most at risk. We are not ruling out for Australia for now, but then we do see that the point is that there may be some record low numbers coming in for the policy rate expectations for RBA. I think we are looking at minus plus 0.1 in the upcoming meeting in November next week. And there will be more, most probably QE coming in from BOJ and ECB. And that will probably set the stage for the interest rate environment for the next few years. And here itself, my final slide I just have a quick roundup of the rest of some of the key takeaways that I talked about. And here we have a link on our recent quarterly report that covers a lot of the material that I just talked about. And my colleague Kunhao would now be talking a bit more on the US election outlook and what does that mean for the markets outlook itself. And I thank you for your time, and I will stop sharing here, and I'll pass the time to Kunhao for the next segment.
Thank you for joining us. I'll do a quick rundown of what to expect for the election, and of course, how does that affect financial markets, specifically, basically the US dollar, as well as interest rates. Okay, so I think by now, everybody's looking forward to next Wednesday, and we should have some form of result by next Thursday morning in Singapore. Having said that, because right now, this time round, there is a significant portion of votes that are on postal voting. So some states may not have very clear results within 24 hours. So just keep that in mind about the contentious nature of this election. So what's going to happen on 3rd November? Basically, on top of US citizens electing Donald Trump or Joe Biden, you have all of the House of Representatives that will be up for grabs, and about 1/3 of the Senate that's up for grabs. So I'm sure you saw all this news reports about permutation, whether you have an all blue wave, where the Dems take over the presidency, meaning Biden wins the presidency and the Dems win both the House and the Senate, or you'll get a fluke election result where you get a red wave, right, where Donald Trump stays as president and the Republican controls both House and Senate, and then you get permutations in between. Now, the long and short answer to what will happen on 3rd November is this. Markets are gravitating towards a blue wave, meaning Joe Biden wins, and meaning the Dems take over House and Senate. If that happens, obviously that is very bullish for financial markets, because then the Dems and Joe Biden can straight away pass a huge fiscal stimulus in excess of $2 trillion US, and equity markets will do well, and the dollar will stay weak, so on and so forth. It will be risk on, it will be positive. If the off chance that Donald Trump stays in charge, the off chance that both the House and Senate still stays with the Republicans, then no love lost. It's still business as usual. Life goes on. We're all used to Donald Trump now. We're all used to his tweets. Some of it are quite fun. Some of it are a bit unfortunate. But life goes on, right? And we will find a way around that. And of course, the focus is still on COVID-19, which is the difficult thing across the US and across Europe. The one thing that financial markets are very, very afraid of is the in-between. What if you get the president on one side and you get an opposite party controlling the House and Senate? That to us is the worst case scenario. Doesn't matter who's in charge, but basically the presidency belongs to somebody and the House and Senate, or the mixture of that, belongs to an opposite party. Then you will have what you call a lame duck president. You can imagine the political gridlock, given that it's so difficult now for the 1 month. Pelosi and Mnuchin are trying so hard to pass a stimulus package. They are holding the US economy on hostage, and yet they couldn't do so, right? So imagine after the election, you get blue and red, side by side. It will be messy, and it is not something financial markets want to see. And if that happens, unfortunately, that is risk off. That will be very negative for equities, of course, because unfortunately, nothing will get done, right? There'll be a lot of political infighting, and financial markets and economy and our life doesn't wait for this, right? Because COVID-19 is still, rampaging in the background. So just keep in mind, just permutations, and let's hope on the 3rd of November, we get a clear outcome of either, best case, a very, very strong Biden win, and that, such that so large a margin that Trump cannot claim electoral fraud, and that Trump will obediently and quietly leave the White House by January. So the timeline is this. If there's a dispute on the 3rd of November, you have all these timelines, right? 8th of December, by then, somebody should come to a gentlemanly agreement. If not, the courts get involved, so on and so forth. But inauguration of the new president is on the 20th of January. So your worst case is things get messy and muddy, and you can get a lot of uncertainty all across Christmas and New Year, all the way up to the 20th of January. But of course, US is a democratic country, and they have a history of solving their differences, coming together after any major election. So let's hope this is the case, and let's hope Donald Trump abides by the US presidency code of conduct. So that's the 3rd of November. Now, heading into that, financial markets are very, very complacent, and I stress on the word very, very complacent heading into this election. As I said, everybody is pricing in a Biden win. More and more are pricing in a sweep, a blue wave by the Democrats, right? So you can see there's virtually very little volatility in the interest rate front and minimal volatility in the FX front. In recent days, like last night, on the equity front, things are getting a bit, dicey, because suddenly everybody appreciated the risk that if you don't get a clear result, what happens if blue and red ends up in some sharing after election, what happens, right? So there's a bit of volatility in the equity front, and I think that's very, very par for the course. Markets should not be complacent, should be a bit more careful heading to election. Now, for now, the race is Biden's to lose. As of last count, it's 60%. Trump is about 40%. So there's a very comfortable lead of more than 10% for Biden. I think anything more than 10% is good. And again, that's assuming you trust the polls, right? The polls this time around supposedly is much more accurate because it has adjusted for the lost demographic that caught everybody unaware that voted for Donald Trump back in 2016, 2017. So this time around, supposedly the maths the sampling, the statistics behind the polls is much more accurate and had adjusted more, to constituencies that and demographics that favor Donald Trump. So still, let's see how it goes, but it is Biden's race to lose. So that's in terms of the election. What do we expect for so-called financial markets going forward? I think you hear a recurring theme just now from Alvin, where he talked about the economy. That rebound in the third and fourth quarter as various cities reopen, which is why it's so a bit scary now that Europe, France, Germany are going back into certain forms of curfew. COVID is, again, daily COVID cases are back at record highs in the US again, because what the economy is most afraid on is if you get another, in Singapore terms, another circuit breaker, right? If things get locked down again, retail gets shut down, businesses will fail, and of course, our jobs will be at stake. So having said that, if you don't get another full lockdown, you can see what Alvin has been saying. Your third and fourth quarter this year, basically, there is a very, very strong rebound, right, in the economy. And we're going to see that later this week as well, whereby the US economy, the third quarter rebound will be very substantial. We had a huge contraction in the second quarter. Now we've got a huge rebound. And this is the case for most economies, meaning third and fourth quarter this year should see a very substantial rebound. The question is this sustainable, right? Is this, how should I say, to be continued into 2021? Now, obviously, you're not going to get a 30% rebound in the economy every quarter. That's just not possible. But what we hope for is that in the US, the fiscal stimulus will not be delayed that much after the election. The Reds and the Blues will work together, will cooperate after the election to pass quickly the fiscal stimulus in the US that is so desperately needed, because so that the US rebound in the fourth and third quarter will continue into 2021 and will not be held in jeopardy. Now, why is it so important? Because that fiscal stimulus package will involve renewed assistance to jobs. In the US, they call it employment checks, right? Where they send checks to everybody just to help them tie across this period. So the employment checks have all stopped by September, right? Started in May, it stopped in September. And that new package is so critical that it's needed to renew all these employment checks and assistance to the US citizens again. Now, outside the US, in Asia, we are watching very, very closely what's happening in China. Sometime the next few days, across the end of the month, Beijing should announce the new 5-year plan. So this is the 14th 5-year plan since China's independence after World War II. And it is very important because the previous 5-year plan, basically from 2015 to 2020, focused on GDP growth, focused on internationalization. It's China's coming of age. Now, given the change in external landscape, given the difficulty of the US-China relationship, right, the new 5-year plan will now focus more on more balanced growth, more quality growth, and what they call building 小康社会, and what Xi Jinping says, basically, Xi Zuxi says, 双循环, 内循环, which in English means double circulation, right? So the economy is supposedly more balanced. There is still the continued push to engage internationalization, right? Basically globalization, that will not stop. But of course, there's also a renewed focus on the quality of domestic growth to balance off the external headwinds. So we'll be looking at the new numbers, the new initiatives for the next 5 years. What is the GDP expectation? Is there going to be a GDP expectation for China? Do they think growth will stay above 5 or 6%? Or are they going to scrap the GDP target altogether? Because we are in Asia, because China is Singapore's largest trading partner, so we care a lot about what's happening in China. So growth expectations for 2021 will depend on whether US gets the stimulus to sustain this strong growth recovery and how China's new 5-year plan works out. As for the currency and rate space, I guess this is what it is. Now, whether you have a red or blue wave after November the 3rd, the Federal Reserve will always be around. Jerome Powell will always be around, right? And that means very easy, very extensive QE will be around. So I'm sure we are all aware of the amount of QE and pump pricing by the US Federal Reserve since COVID-19 started at the beginning of the year. Now, I've got a hedge fund friend who used this analogy, and I think it sums it up very well. When Ben Bernanke did QE in 0809 during the Lehman Brothers crisis, okay, we call it helicopter money. You get all this newspaper comics of him sitting on top of the helicopter, throwing down cash into financial markets, right? Now, my friend said that what Jerome Powell is doing now, because of COVID QE, is like he's driving a B-52, Stratofortress B-52 bomber, and dropping cash. So you can see the difference, right? Helicopter and B-52, but this is what it is. The money supply indicators are all off the charts for the US. Now, keep in mind that at the very basic, the Federal Reserve is buying 80 billion worth of US Treasuries every month, 40 billion worth of MBS, mortgage-backed securities, every month, and this continues ad nauseum. On top of that, there is 9 intervention facilities in money market, in basically your ABS, in treasuries, in corporate bonds, in ETFs, you name it. This is your B-52. And the money supply, M1 indicator in the US, has jumped by like 40 over %, right? So far compared to the year before. When it was Lehman, it's just barely about 20%. So you can see how much money printing, how much helicopter or B-52 bombing, this is. So this is why the US dollar is weak. This is why interest rates are low. This will not change whether you get Biden in charge, because they need to heal the economy. And of course, Trump will be happy to continue this. Remember what he did, what he wanted at the start of his presidency. He wanted Jerome Powell to drop rates to 0. And there you go. It has happened, although it's not because Jerome Powell listened to him, but because of COVID-19. So that's the underlying reason why the dollar will be weak, irrespective of red or blue. In terms of gold, we at UOB like gold a lot. We call gold the anti-US dollar. And as long as the broad conditions of a weak dollar, of easy monetary policy continues, gold will stay strong. So near term, there's a bit of volatility in gold. Gold is a bit weak because, it is very so-called overcrowded positioning. But overall, we still believe gold will trade higher and will still go up to 2,200 per ounce by the middle of next year. In Asia, remember what I said before about China's new 5-year plan? Now, the renminbi is very strong now. It's not just the US dollar is weak. By virtue of itself, by virtue of its own so-called characteristics and indicators, the renminbi is strong. First, we all agree that China and Beijing controls COVID-19 much better than the US. That's a given, right? We don't even need to discuss about that. Second, because of that, the economy is recovering much faster and better than the US. By all accounts, the Chinese economy is mostly back to pre-COVID levels, as Alvin mentioned earlier about the GDP numbers for China. And by all accounts, domestic consumption is back to pre-COVID levels. China's economy basically has recovered at least 1 or 2 quarters ahead of the US. And that's a very good advantage. So renminbi is strong. Why is the renminbi strong? The other reason, on top of the economy, on top of how well they handled COVID-19, is because the yield spread. Chinese 10-year government bonds now pays about 3.2%, right? Whereas US Treasuries in the 10-year pays about 70 to 80 basis points. So that gap is very wide. That gap is about 2.5%. It's significant. It's huge. Given that most of the developed markets and the rest of the world are all at 0 interest rate, and that, as Alvin mentioned earlier, Australia may cut again, Bank of England may cut again, New Zealand may cut again. You can't find anything more than 0.5% in terms of yield in the developed space. And for a major economy, if you want proper fixed income allocation, you got to look at China. And China, that yield differential is 2.5% above US Treasuries. So you will find that more and more investment allocation in this new decimated landscape of zero yield, the post-COVID world, zero and negative yield for the developed space, will skew more and more towards China. China is the new Australian dollar, so to say. Renminbi is the new Australian dollar. Renminbi is the new high yielder because with a yield advantage of 2.5%, it's remarkably good. Now, if I tell you as a retail investor, if we can, how should I say, afford that capital control risk, who does not want to get 3% on your long-term deposit rate? This is where we are. So that's China. This is why renminbi is strong on top of a weak US dollar. So we're positive on renminbi, which means by extension, we are also positive in the Singapore dollar. Now, a lot of people are asking, why is Singapore dollar so strong, right? 135, 136 now. Shouldn't we be at 140, 141, 142 because the Singapore's economy is in a deep recession? The answer is no. Why? Because China is Singapore's biggest trading partner. Our risk in terms of trade and financial links to China is huge. It is the largest. It has overtaken the US, obviously overtaken Malaysia, overtaken Europe, Japan, Korea, so on and so forth. So if renminbi strengthens, Singapore dollar will strengthen. It's as simple as that. So our view is that we see renminbi strength, we see Singapore dollar strengthening further to about 133 by the middle of 2021. Now you see these two charts. The blue line is basically dollar renminbi, and the red line is dollar sing. Both move in sync. So which means if renminbi strengthens, Singapore dollar strengthens. It's as simple as that. In terms of the other spaces in Asia, we are concerned about Indian rupee. We are concerned about Indonesian rupiah because both countries have long-term structural deficits in their current account, in their fiscal account. And if you look at this chart, this is a 20-year chart. Basically, both currencies, rupee and rupiah, are in long-term depreciation. So obviously with COVID-19, it's making the situation even worse for their local finances. And that means the currencies will stay weak. As for interest rates, I've said earlier, the Fed has committed to keeping interest rates at zero for as long as it takes, to help fight this COVID-19 crisis. And you see that the futures indicator, the futures market, have all priced out any rate hikes, at least until end 2022. Some would argue that, in fact, the Fed will stay at zero until 3, 4, 5 years later. But you get the picture. Alvin has said earlier, right, developed market interest rates are all near zero, 10 basis points for the Bank of England, 25 for Australia, New Zealand, and Canada. And there's risk that, Australia will go down to 10 and Bank of England will go negative. But you get a picture. International rates are all near zero. And this is the damage to the yield curve by COVID-19. In Singapore, SOR and SIBOR basically are down there as well. So SIBOR is that dark blue line. SOR is the weekly light blue line. Both lines follow the red line, which is US LIBOR. So as long as LIBOR stays low, 20 basis point, 15 basis point in 3 months, SOR and SIBOR will follow, and we don't see much changes. And you can find that short-term rates will stay near zero as well. So you'll be forgiven to believe that if that's the case, why worry about interest rates? Interest rates will stay low, it will not move, it will be just above zero. COVID-19 is not going away anytime soon until we get a proper vaccine. So why worry about interest rates? This is what it is. The amount of outstanding debt in the US has jumped, and it has jumped very, very significantly. To pay for all the stimulus, to pay for all the COVID-19 costs to jobs, to the economy, to the industry, basically the amount of outstanding treasuries issued by the Trump administration has jumped from about 23 trillion at the start of the year to above 27 trillion now. Now, if they pass another stimulus package next month after the election, this thing will pop 28, 29 trillion. You get the picture. At a time where the US economy is contracting, GDP heading below 20 trillion. So what this means is this: your debt to GDP ratio for the US has jumped. So the debt burden for the US government has jumped. And in a sense, this chart in different forms is the same for most economies in the world. If you ask me at the beginning of the year, will the Singapore, so-called government go into deficit at the beginning. I will say no, it's not happened before. Singapore, we are proud to have a fiscal surplus. Our reserves are huge. We will never have deficit. But there we are, because of COVID-19 and 4 stimulus packages later, we are now at an unprecedented 20%, fiscal deficit of GDP. Japan is the same. Australia is the same. Most economies, the fiscal balance for the year is -10, -20%. It's just, very, very difficult, very, very alarming. And as a result of this, you will find that there'll be a whole round of downgrades coming next year. Fitch has said that they have put the US on negative watch for the next 6 months, which means there's a high risk that US credit rating, sovereign credit rating, will get downgraded in the next 6 months. The same for a lot of other countries everywhere in the world, from the US to the Middle East to Europe to across Asia. Now, what this means is long-term yield will not stay low. Now, as I said before, short-term money market rates will stay low because of easy monetary policy, but long-term yield will be driven by all these credit issues, by all these potential, little defaults here and there, and they will trend higher. So you see, for example, 10-year US Treasuries and 30-year US Treasuries, which is this rate circle, yield has started to creep higher. So this is something I want to highlight to everybody. Do not assume that interest rates will stay low forever. It will not be the case. There are things bubbling in the background. And if next year COVID-19 does not go away, right, if we don't resume international travel, you will find that there will be defaults in the difficult parts of the economy, right? It will basically be, in tourism, in hospitality, right? In all the manufacturing firms, there will be difficult times. There may be defaults, and there'll be sovereign downgrades as well. So yield may not stay low because of credit issue. So just take note of this. So if I summarize quickly, red or blue, right? Dollar will be weak. It's a question of how weak. At the same time, renminbi is strong for its own reasons, and the economy is doing better. The yield spread is good. In Asia, we like the Singapore dollar as well because the renminbi is strong. For the interest rates front, do not assume that short-term rates stay low because of the large central bank easing. Long-term rates will not stay low because there is rising credit and default risk coming up. So on that note, I'll stop my presentation. I'll pass the time back to Felix for the Q&A. Thank you.
Okay, thank you so much, Kun Hao and Alvin, I think, for the valuable insights. We hope everyone in this audience has found it useful. We now move into the Q&A. So, but before we do that, just a quick reminder, you should see the feedback survey, which will appear on your screen right now on the right. So please do share your thoughts. Your inputs will be very, very valuable for us as we move through this program. Now, the other thing is, obviously, with time constraints, there's only so much that Alvin and Kun Hao can cover today in this session. If you're interested to know more about other research insights, do visit our website, which is uobgroup.com/research, uobgroup.com/research. You can find a lot more the quarterly updates and even the weekly FX expectations for your own interest. Okay, so let's dive in straight into the Q&A. The first question, do you see relations between US and China improving, right? And if there's a change in US president next week, what would be the implication?
Okay, thank you, Felix. I'll take this question. I mentioned in my presentation, right, in the earlier part of my presentation, that despite regardless of whichever president that US may elect next week, one thing that we find that will be a constant, right, will be the continued deterioration of the US-China relations. The difference is probably if we get a Biden victory, right? Biden will be more cordial in his way of negotiation, but we would think that the relationship between the two countries will continue to be challenging going forward. One of the key things that the reason is that the US sees China, the competition with China as a zero-sum game. That means there can only be one winner. And the fronts that they are looking at, of course, the more prominent ones are trade. It started off with trade, but then we already know that it has moved on to other areas like technology, whereby some of the key Chinese manufacturing key technology companies have been shut out, has been under strain from the US, has been under the microscope of US authorities. And some of the things that if you need the example of going forward, why would whether the change of presidency or the same president itself will not change this dynamics is that you look at the past, I think 12 to 18 months, whereby the US Congress, they passed bills and measures against China itself. You know that the Democrats and Republicans in that period itself hardly agreed on anything. But one of the things that they had a very unified view on is their view on China. And those sanctions, be it related to Hong Kong or be it related to other areas, right, is passed almost with unanimous decisions among both Democrats and Republicans. So with that in view, right, in mind, right, when we move on to the next 4 year term of the next president, right, the Democrats and the Republicans, the composition will still be that same group of roughly the same group of people. And then if they are roughly the same group, you will find that their view towards China would still be the same. And so the short answer would be that this is the only constant that we believe that will come out from the US elections, is that the Chinese and US relations will continue to be challenging going forward.
Now, so maybe building on this point, because I see that as a related question again, on the U.S. election, is that's for China, but how about what would the results mean for Southeast Asia?
What would the results mean for Southeast Asia? As Kun Hao has talked about, right, Southeast Asia, right, is including Singapore, right, the biggest trading partner for us is China. So we have in the past, I think the past decade itself, a lot of the region, including Singapore, has benefited from the rise of China, the economic strength of China. We have benefited. But going forward with the expected deterioration of relations between the two countries itself, regardless of the presidential outcome, right, we would be facing that challenge itself. Of course, there will be opportunities. The opportunities is given from the diversification of investments away from China that could actually, some of them could flow to the region itself. But on the challenge front, right, and it would increasingly be a topic, right, is that we may be increasingly seen to be needed to pick sides between US and China. I think we see that development already in the technology space, the 5G space, whereby there is that tension which is quite evident in already in Europe and in many parts of Asia. So I think those are the challenges that we will see going forward for after the US president elections that will continue on the challenges of trend between the US and China itself.
Okay, thanks, Alvin. And okay, so the next question, where do we see the central bank's interest rate policy in the next few years?
I think, Kun Hao, would you like to take this? Because you have mentioned this earlier.
Sure. Okay, I assume this means developed central banks or, in general. Now, in general, I think, okay, let's break this up into a few parts. First, most of the central banks, whether it's in developed space or in Asia, will have done most and all of the rate cuts that they need since March. April and May, right? That big rate cut. So a lot of the interest rates cuts are over. They are all flat line. In the developed space, that means most of the rates are all near zero or just above zero. In Japan, Germany, they are all negative. Okay, now having said that, over the near term, while we do not see any more rate cuts, there's a risk that COVID-19 may stay with us much longer than expected. That's something unfortunate, but there's always that risk. Now let's assume that you get another year of lockdowns, you get another year where air travel doesn't resume, you get another year where we talk, let's say next October, November, where there's no workable vaccine for everybody to use. That means clearly there needs to be further more central bank easing to come. So I would reframe this question as, instead of interest rate, what's monetary policy? Because rates are all near zero, it's going to be very hard for central banks to continue to cut into negative, right? Because we're seeing negative rates in Japan and Germany, they don't really help the economy. And they are very, very bad for the banking system, for banks, right? So central banks will get innovative. We're going to do more QE, right? We'll have to do more of what Jerome Powell does on his B52, right? So let's hope it doesn't happen. But if COVID-19 stays with us for another 1 year or 2 years, you're going to find that there'll be more QE, not just in the US and Europe and in Japan, but all across Asia. Maybe the day will come where the MAS starts to buy into STI ETFs or buy into Singapore government bonds. Right? That's not our forecast, but you never know. That may be the case if COVID stays with us for a longer time. Yeah, Felix.
Okay, thanks, Kun Hao. Okay, I'm going to read out these two questions because I think they are sort of related to currencies. So the first question is, why is the Singapore dollar so strong despite Singapore having a deep recession? And I suppose this is with regards to the US dollar. Now, relating to that is the follow-up question is, how weak can the US dollar get? And is it true that some news articles say that the dollar will collapse by 1/3?
Thank you. Well, there's a lot of talk that the US dollar is collapsing. And if you look at the logic behind it, most of this came from all the hedge fund managers. And of course, if you're familiar with Paul Krugman or Nouriel Roubini, esteemed economists, they've been going around, Stephen Roach, they've been going around saying that US dollar will collapse. And again, for very valid reasons, they are not incorrect, right? First, you saw in my charts, the amount of US deficit is just incredible. The amount of US debt accumulated is just incredible. US, some will say point blank, US is broke, and in a sense, yes, right? And that's just bad for their currency. Second, you saw my M1, M2 chart, money supply, it's just unprecedented in terms of printing money. That will make the US dollar weak. So in a sense, from that angle, right, the difficulty that's going through in terms of the US dollar should be weak. But do not forget, on the other hand, there are reasons that will support the US dollar. No matter what, the US dollar is still the reserve currency in the world. Meaning, no matter how bad things are, how much US treasuries the US government is printing, right? All the central banks in the world still need to buy US dollars, still need to buy US treasury. As an average, about 2/3 of the world's reserves is in US dollar. That's how much it is. It's multiples of trillions of dollars. Now, on top of that, US dollar is still the preeminent payment and transaction currency in the world. In terms of SWIFT indicators, that number again is as high as even 90% in some cases. Basically, those of you with how should I say, international trade, right? If you need to import or export outside Singapore, you will know what I mean, right? You will still need to transact, pay, and sell your goods in US dollar. That's what this is. I have conversations with a big Chinese customer, and he was telling me something very interesting. He says that he is buying commodities from a Russian company. So you heard all this news, right? Russia and China are trying to come together to diminish the use of US dollar, to try to encourage the corporates, between two of them to pay in renminbi or pay in Russian ruble. But he says that despite all this, right, there is no liquidity. He still needs to buy US dollar to pay for his commodity that he's buying from a Russian firm. He can't pay in ruble, he can't pay in renminbi. And that's the truth of the current payment system. So yes, the reasons for the US dollar to be weak are there, and they are very scary reasons. But on the other hand, the existing forces that are supportive of the US dollar in terms of reserve, in terms of payment, are still there. So if you balance these two off, our view at UOB is that you'll get a gradual medium-term decline in the US dollar, 1 or 2% a quarter. But you're not going to get a one-third collapse, because that just will not happen in our greater scheme of things. And the last question about why the Singapore dollar is so strong, is because we follow the renminbi, and the US dollar backdrop is still weak. If I'm in Bangkok, everybody will be asking me why the Thai baht is so strong. If I'm in Malaysia, everybody will be asking me why the Malaysian ringgit is so strong. So it's as simple as that. The backdrop is a weak US dollar, strong renminbi, and that keeps our regional currencies, whether it's Singapore dollar, Thai baht, Malaysian ringgit, strong.
Okay, thank you, Khun Hao, for breaking it down. Before we move to the next question, again, just a quick reminder, if you have not already completed the feedback survey, please do so. It's just a few questions over there. We really appreciate your inputs. Okay, the next question is on gold. Now, despite all the positive forecasts, right, gold has weakened past 1 month and has now fallen below, $1,900. Is gold's rally over?
Okay, I'll take that one. Well, last night we all saw that big sell-off in the US equity market, right? And of course, gold is also sold back down below 1,009 to 1,870, around there. Some are asking that, because we were just at 2,000 over just 2 months ago, so have we seen the best for gold? It's now coming down. The answer is no, because gold will still be positive, because central bank policy is easy, because short-term interest rates are still near zero, and because of all the massive monetary policy easing. Some are also using gold as a hedge against US dollar weakness. If you're worried that the US dollar will really collapse, you will buy a bit more into gold just as an allocation, just in case. So if you look at all these things don't go away in the next few months. Unless the only reason if gold will collapse is, let's say tomorrow, suddenly you get a vaccine. And suddenly you get a vaccine that works well, and suddenly that vaccine is available to all of us. You can, basically vaccinate all of us in the next few weeks. Then, this COVID-19 trouble is over, and you will find that the need for a gold hedge will not be there. Now, stopping short of that, this is a struggle. You have on-off, in terms of COVID outbreaks, and that risk aversion means you still need gold. So we're still positive on gold. We believe that after this short-term correction, gold will still go back up above 2,000 per ounce.
Okay, so I think we have answered all the questions. Right, thank you, Alvin and Khun Hao. So again, for the audience, thank you for your time and engagement today. So if you have further questions on today's content, scan the QR codes. And we hope you found today's webinar of value and will join us for our upcoming sessions. Now, in the meantime, we encourage you to view our video on demand catalog to grow your skills and knowledge at your own pace. So topics include promoting your business online, tools for productivity, government relief measures, support from UOB's FinLab, and more, right? And also, if you have missed the previous session on retail insights and export tips, you can also view the recording on this site, which is smeleadershipacademy.withgoogle.com, right? smeleadershipacademy.withgoogle.com. So thank you once again all for attending. Stay safe and healthy. We hope to see you in upcoming sessions.
Bye-bye.